California remote work tax. You moved out of California, you kept your job, and the paychecks still come from a company back in California. The question is whether California still gets to tax that salary. For the work you do outside the state, the answer is no. The authority is Revenue and Taxation Code Section 17,951. For a non-resident, gross income includes only income from sources within California. So everything turns on where your wages are sourced. The Franchise Tax Board answers that directly in Publication 1031. Wages have a source where the services are performed. And then it says the part most explanations leave out. Neither the location of the employer, nor where the payment is issued, nor your location when you receive payment affects the source of that income. That disposes of three theories at once. A San Francisco headquarters does not matter. Payroll cut from a California bank does not matter. Logging into a California server does not matter. What matters is where you were sitting when you did the work. Now the part that actually costs people money. Days you spend working inside California are still California source income. If you fly back for planning weeks or a conference, those days count. And the regulation tells you how to count them. Title 18, Section 17,951-5, Subdivision B. You allocate by workdays. California workdays on top. Total workdays on the bottom. 18 California days out of 230 total workdays is 7.83%. On a salary of $220,000, that is about $17,000 of California source wages. Not the whole salary, but not zero either. Here is the other half of the problem. Your employer may still be withholding California tax months after you left. The rule for that sits in the Employment Development Department Information Sheet DE231D. California withholding applies to a resident anywhere or to a non-resident for services performed inside the state. A non-resident working entirely outside California falls outside both descriptions. One correction worth making. Form 590 is not how you switch it off. On that form, an individual certifies that they are a California resident. Handing it to your employer would certify the opposite of the position you are taking. If California tax was already withheld, you recover it by filing Form 540NR and claiming the withholding as a credit. And one more thing California does not have: a convenience of the employer rule. Some states tax your remote days as if you had worked at the employer location. California does not. So the move itself does the work. What is left is your residency date and a day count. Keep that day count as it happens. It is the part that is hardest to rebuild later.